Alright, I'm back again to give you another lesson in really hard accounting. And in this lesson, we're going to translate the results of our foreign subsidiaries into the presentation currency of parent corporation. Let's dive right in. We first saw this chart a few lessons ago when we started discussing the topic of foreign currency translation. And in those lessons, we were primarily focused on the second column in this chart, whereby a foreign operation was largely an extension of the parent company. In this lesson, we're going to focus in on the third and the fourth columns, and by virtue of that understanding, I'm hoping that you should be able to derive financial statements to address the fifth column. The fifth column is that rare circumstance where your functional currency is different than your presentation currency. Say for a Canadian company that chooses to report results in US dollars because it's listed on the New York Stock Exchange. We discussed previously the importance of identifying the appropriate functional currency. And the functional currency is intended to reflect the economic environment in which the entity operates. IAS 21 provides factors that help us in making this distinction. The arrows with the T's and the C's indicate the method of translation and the topic of this lesson. T stands for the temporal method and C stands for the current rate method. We will circle the wagons and return to this chart at the end of the lesson. And hopefully by that time you'll kind of understand how this chart gets applied using these methods. Now, as we just indicated, it's important for us to be able to choose a functional currency. Now, the first 5 items on this list are the very same that we saw in a previous lesson. The bottom 5 are new. You can pause this video and review the list in detail at your leisure. We will choose the domestic currency, that is, the currency of the parent company, most often when we have an integrated foreign subsidiary. That would be depicted by the third column on the previous slide. And we'd use the local currency, that is the currency of the foreign country, when the subsidiary is self-sustaining. Making this distinction is necessary so that we can apply the method of translation. Keep in mind the objectives at the outset. With an integrated foreign subsidiary, we want to portray the results as if the parent itself had undertaken those transactions. So, in the same way we saw the gains and losses through net income in previous lessons, we would expect to see the same end result here when you apply the so-called temporal method. Only the monetary assets represent exposure in this context. Investments in non-monetary items, as we saw with our land development project account in Texas, are not adjusted subsequent to the initial investment. With the self-sustaining forest subsidiary, the parent sees things a little differently. It sees the subsidiary as an investment of sorts. In other words, an exposure to a foreign market. And as such, the current rate method tends to provide a more current reading of the value of the assets and liabilities of the foreign subsidiary by using the most current and up-to-date exchange rates. These gains and losses are unrealized from this perspective, and as such they get parked in other comprehensive income until we liquidate a portion or all of our investment in the foreign subsidiary. An interesting side note is that when the parent hedges its net investment relationship, say with a forward contract, remember that we have hedge accounting rules available to us to park those gains and losses in other comprehensive income. But let's not get carried away. Let's cruise through an example and see how this works. Parent corporation buys 100% of foreign corporation for $256,000 on January 1, year 1. Thankfully, we have no purchase price differential to worry about. The relevant exchange rates are noted here. Note that at the date of acquisition, one foreign currency unit was worth $0.128, and by the end of the year, it was only worth $0.104. We can therefore expect a foreign exchange translation loss if we have a positive exposure. And by that I mean we have more foreign currency assets than we do liabilities. It would be the reverse if we had a net deficiency. Let's start our simple example. These are the financial statements at the date of acquisition of foreign company. It doesn't matter whether we use the temporal method or the current rate method to translate these statements. The results are the same at the date of acquisition. Let's take a moment to review our understanding of our assets and liabilities. Our monetary items would include cash, receivables, current liabilities, and bonds payable. Our non-monetary items would include inventory, property, and plant. By now, we should be able to consolidate this balance sheet in our sleep. The $256,000 we paid would be set up in an investment account on the books of parent corporation. This would get eliminated against the common shares and retained earnings of foreign company, which also equals $256,000 because there was no acquisition differential. The remaining assets and liabilities would be combined with parent corporation, and bada bing, bada boom, and you got a consolidated balance sheet. So here's your master table indicating which accounts get translated and at what exchange rates for each of our two translation methods. The closing rate is the exchange rate at the year-end date. Non-monetary items at cost differ between the two methods. With the temporal method, we use the historical rate, which alleviates any gains or losses on translation. With the current rate method, we adjust these non-monetary assets and liabilities using the current exchange rate, which necessarily creates a gain or loss at each reporting date on these items. Non-monetary items that are based on the fair value are actually translated on the exchange rates in existence at the date of the valuation. Historical rates are those at the transaction date for the common shares. That would be the rate at the date of acquisition. Dividends are translated at the exchange rate at the date of declaration. Revenues and expenses under both approaches use the historical rate, and for practicality purposes we would use the average exchange rate for the period to translate these amounts, which implies that the revenue and expenses were incurred evenly throughout the year, a simplifying assumption that may not be true in certain circumstances. Depreciation and amortizations vary between the two methods. For the temporal method, depreciation and amortization will again be translated using the historical rate at the date the asset or the liability was acquired. Whereas under the current rate method, the historical rate refers to the average rate throughout the period in which the expense was recorded. The same sort of comments apply to the cost of sales. With the temporal method, the opening inventory will be translated at the exchange rate used at the last reporting date for inventory. Purchases will be translated using an average rate for the year, and the closing inventory balance will be again based on the rate in effect when the inventory on hand was purchased, which is not usually the same as the closing rate. For the current rate method, it's a whole lot simpler because each of these items are translated using the average rate. So let's see how this actually works in our example. So let's look a year out and work on translating the first year results. First, we will start with the temporal method. Our translation exposure to foreign currency is limited to the monetary items only. So we can actually calculate our net monetary position in the purple table highlighted on your screen. At the beginning of the year, we had a net monetary position of a negative foreign currency 100 units. The position deteriorated further to a negative foreign currency 200 units by the end of the year. Being in a negative net monetary position, coupled with a weakening exchange rate, should mean that we are looking for a foreign exchange gain. Let's work the math in the larger table. We can calculate the net monetary position by tracking and translating each of the cash flows during the year, including sales, purchases, interest paid, cash expenses, and dividends paid. Note that it is cash accounting, not accrual accounting, because we're interested in the change in our net monetary position. This results in a calculated net monetary position of a negative $23,000. Our actual position can be translated at the year-end date using the closing rate of $0.104, giving us the actual net monetary position of negative $21,000. To true up our balance sheet, we need to report a $2,000 foreign exchange gain through regular income. Let's draft the statements. We begin with the income statement, and sales are translated at the average rate for the year, as are the expenses and the bond interest. Depreciation arises from the non-monetary item, so it gets translated at the historical rate at the date of acquisition of the related assets, which in this case was $0.128, which only leaves the cost of sales. Cost of sales under the temporal method takes a little extra work to calculate because inventory is a non-monetary item. The beginning inventory, which was acquired at the date of acquisition, would be translated at the $0.128. The purchases, which we'll assume occurred evenly throughout the year, will be translated at an average rate of 0.115, and the ending inventory will be translated at the date of acquisition, in this case 0.11. With this calculation in hand, we can now slot the $829,000 back into the income statement. So we put that $829,000 in our cost of sales line. Finally, the foreign exchange gain of $2,000 was calculated at the outset and now gets included to give us net income of $12,000. Note that you can also get at this amount by drafting the income statement and balance sheet and using the required plug amount to determine the $2,000 gain. Both ways should yield the same answer. The retained earnings statement begins with our opening balance, which comes at the date of acquisition, or from last year's financial statements. It gets translated at the historical rate. Net income, we have just calculated, and dividends are translated at the exchange rate at the date of declaration. This gives us retained earnings of $66,000. We can now move on to the balance sheet. Foreign company has a fairly straightforward balance sheet. Our monetary assets of cash, receivables, current liabilities, and bonds payable all get translated at the closing rate. Our inventories get translated at the rate in effect at the date of purchase, and the same for our other non-monetary assets, in this case, property and plant. Common shares are translated at the historical rate, being the date of acquisition, and our retained earnings of $66,000 was the number we just calculated on the previous slide. The process from here to consolidate foreign company into parent corporation is the same process as we've been learning about throughout the course. The parent's investment will get eliminated against the common shares and retained earnings of foreign company. Since there is no acquisition differential to consider, the remaining translated balances will be combined with those of parent corporation. So now we can move on and let's look at the current rate method. Now for the current rate method, we can use the same sort of approach. First, let's begin by calculating the translation gain or loss. This time, it's not the net monetary position we are interested in, it's the net asset position. In other words, the whole enchilada. All the assets and liabilities on the balance sheet. Or said another way, the shareholders' equity. The net position of foreign company was foreign currency 2 million units at January 1st. And foreign currency 2.2 million units at December 31st. It's a positive number this time, which means that parent corporation is exposed to any currency weakness, which is indeed the case here as the exchange rate has dropped from 0.128 at the beginning of the year to 0.104 at the end of the year. Thus, we can expect an exchange loss of some sort on this translation. Using the same approach as we did for the temporal method, we can reconcile our net asset position by tracking the changes that occurred during the year. Now these are a lot simpler to track in the current rate method because the entire income statement is translated at the same rate, that being the average rate for the year. To that, we need to adjust for any dividends that were paid, which gives us our calculated net asset position at December 31st, year 1, of $280,000. We compare that against our actual net asset position translated at the actual closing rate of 0.104, which gives us an actual net asset position of $229,000. And it's no surprise that it's $51,000 less than the calculated position given the devaluation of the currency. Let's draft our statements. Our income statement is pretty straightforward. All the items, including the cost of sales and depreciation, are translated at the average exchange rate for the year. Note that our foreign currency loss doesn't hit regular income. It gets parked in other comprehensive income as a foreign currency translation adjustment. Our retained earnings can now be calculated using the $35,000 of net income and deducting the $10,000 of dividends paid to give us retained earnings at the end of the year of $89,000. Note that this is much higher than the $66,000 we calculated using the temporal method. Now let's draft the balance sheet. Once again, the balance sheet too is fairly straightforward to translate, as all of our assets and liabilities are translated at the closing rate of 0.104. The common shares are translated at the historical rate as at the date of the parent corporation's acquisition of foreign company. We carry forward the retained earnings from the schedule we just prepared, and the foreign exchange translation loss gets parked as a separate component of shareholders' equity in the amount of a negative $51,000. If we compare this balance sheet to our temporal method, our assets and liabilities are lower, which makes sense because our exchange rates have weakened. And under the temporal method, we only adjusted the monetary items to reflect the closing rate. Here we adjusted all the assets and liabilities. Once again, the consolidation of foreign company into parent corporation follows our standard process, and I'll spare you that story again. Before closing the lesson, let's just hit a couple of miscellaneous items. First, does the existence of non-controlling interest mess up our situation? Not really. The non-controlling interest will take its portion of any translation gain or loss, either directly through the allocation of consolidated net income in the temporal method, or by picking up its proportion of the foreign currency translation adjustment amount reported separately in equity. Next, our simple example ignored acquisition differential. Of course, this isn't realistic, but based on what we already know, I think we can integrate that complexity into the translation rather easily. Under the temporal method, any fair value increments are typically allocated to non-monetary items. So really, you shouldn't see any impact on the foreign exchange translation gain or loss. So just go about translating any incremental amortization and the associated unamortized fair value increment at the historical rate and go from there. However, in the current rate method, you will see additional foreign currency translation gains or loss to include in the adjustment. This arises because the amortization will be translated at the average exchange rate for the year, and the unamortized balance of the differences will be translated at the closing rate, which will only add to the translation gain or loss. And finally, there's a number of developing nations in the world struggling with controlling inflation, and GAAP has special rules when it comes to translating these financials to avoid getting gobbledygook. Some of the factors to watch for are listed here. But before you can even translate the statements from a foreign currency into a domestic currency, you need to apply IAS 29, which states that both the current year's figures and the comparative figures must be stated in terms of a measuring unit current. What the heck does that mean? What that means is that the non-monetary accounts, such as land and equipment, must be restated by applying a general price index. This makes sense because if you had a piece of land that was worth, say, 5 million pesos last year, that once translated equaled $1 million Canadian, but this year is suddenly worth only 200,000 because there was a 500% inflation rate, it just wouldn't make sense. The land that was worth 5 million pesos last year is likely worth 25 million pesos this year to account for the currency depression due to the inflation. So this is the sort of adjustment GAAP contemplates in these circumstances. Note that we are less concerned about the monetary items, as these should already reflect current rates. After the restatement, all the assets and liabilities should be stated at either their fair value or a price level adjusted value to approximate fair value. Then we move on to apply the translation using the closing rate, which should give us a much more accurate assessment of the value of the foreign subsidiary. We won't go through a detailed example of this in this course, as I think we've already exhausted many of the nuances of this particular subject. So I finished this lesson where I started, looking at this chart that guides you as to which approach you'll be using to translate your foreign operations. The third column depicts the integrated subsidiary, which uses the temporal method. The fourth column depicts the self-sufficient foreign subsidiary that uses the current rate method. And as you can see by the arrows in the fifth column, there's a double translation to consider. But that, my friends, I'll leave for another day. And at this point in the course, I just want to congratulate you on your completion. It's been 20-odd some videos with very complex subject matter. Much of this subject matter you will not see in your everyday work environment. But there may come a time at some point during your career that you may come across one of these situations, and in which time you may be able to come back to theFinanceLearningAcademy.com and refresh your memory. We not only deal with the hard topics, but the forgetful mind as well. So that's all for this course. Till next time, never, ever forget, don't stop till you get to the top. When you get to the top, don't stop.